There's a market indicator you might not have heard of, and right now it's flashing a pretty serious warning. It's called the Mannarino Market Risk Indicator, or MMRI for short, and we really need to understand the story it's telling.
So this is the number at the heart of everything, 263.01. It might look totally random, but it actually represents a huge amount of tension that's building up in the financial system.
Now, according to the person who created it, this number signals high risk in the markets. And that's a pretty bold claim. So what's really going on behind the scenes here? What's this thing really telling us? How on earth is this number calculated? And where does it even come from? That's exactly what we're about to break down. Okay, so this whole indicator is built on a really fascinating idea that you can measure market stress by looking at the tension between two super powerful economic forces. The first of those is the strength of the US dollar. So to measure this, we use what's called the DXY, or the US Dollar Index. You can think of it like a scorecard for the dollar against other major world currencies like the euro and the yen. A higher DXY means a stronger dollar. And when the dollar is strong, well, that puts pressure on global trade and companies with international debt, which is a classic sign of strain. All right, so the DXY value we're plugging into our indicator is 98.27. That's the first piece of our puzzle, a pretty strong dollar. Now, what about the second piece? Okay, on to the second component, which is the US government's borrowing rate. This is where the other side of that financial tension really comes into play. And for that, we look at the US 10Y, which is just the interest rate on a 10-year government bond. What's so cool about this number is that it's kind of like a snapshot of the market's collective guess about the future. And a higher yield means it's more expensive for the government and pretty much everyone else to borrow money. It basically acts like a brake on the whole economy. The 10-year yield we're working with here is 4.309%. So there we have it, our two key ingredients, a strong dollar and a high cost for government debt. Let's see what happens when we mix them together.
All right, it's time to put these two pieces together. How do we get from these numbers to that final risk score?
So what's the logic here? Well, the whole theory is that when you've got a strong dollar sucking money in for safety, while at the very same time, high interest rates are making debt way more of a burden, you get this powerful squeeze on the financial system. It's that tension, that squeeze, that the formula is trying to capture. And you know what? The formula itself is actually pretty simple. First, you take the DXY value, that 98.27, then you multiply it by the 10-year yield, 4.309. From there, you divide that result by a fixed number, a constant, of 1.61. Now, this is just a scaling factor the creator put in to make the final number easy to read. And after that last step, boom, there it is, our MMRI value, roughly 263.01. Okay, so we've got our number, but that brings us right back to where we started. What does this number actually mean? Let's find out. All right, we know it's supposed to scream high risk, but how is that even defined? Like, where's the line between, it's okay, and, oh, this is serious? So here's the breakdown. A score between 50 and 100, that's considered low risk. From 100 up to 200, you're in moderate territory. But once you go over 300, that's extreme risk. And our number, 263.01, well, that lands us smack in the middle of that high-risk zone.
Okay, but wait. Seeing a high-risk signal like this can be pretty alarming, right? So it's absolutely crucial that we understand what this indicator is, and maybe more importantly, what it isn't.
Even the person who created this thing makes a really important point. This is not a crystal ball. It's built to show you what's happening right now, not to perfectly predict what's going to happen next. So the key thing to remember is this. The MMRI, it's just one piece of data. It is not a fortune-telling tool. And for sure, it should only be used as part of a much, much bigger analysis. It's one piece of the puzzle, right? Not the whole picture.
So we've kind of pulled back the curtain on this indicator. We see how it combines that tension between a strong dollar and high borrowing costs into one single number. And honestly, it's a pretty fascinating way to try and measure systemic risk. But that leaves us with one final thought. If this indicator is just one tool, what other parts of the picture are you keeping an eye on?